Okay, so hi, I'm Mike Sigal. I've been an advisor to Unbounded for about 4 months now, I guess. Zach and I met in Lisbon through mutual friends, and Zach asked me if I could help him think through some of the implications from the payment industry and a little bit about how the Unbounded platform is going to evolve. And I was delighted to do that for reasons I'll share with you as we go through. The talk that I'm giving you today is a talk that I share with entrepreneurs to help them think through the behavioral economics of fundraising from VCs. And it sort of is going in the theme that we've had a little bit about with transparency and how VC works. And it also gives me an opportunity to sort of tell you why I'm excited to be working with Unbounded. So a little bit about my journey. I'm a multiple-time entrepreneur with a couple of exits. Went through an IPO. I hope never to have to do that again. During 2011 to about 2019, I went deep into fintech. I started off by working with Swift, helping them figure out how to connect startups, which were not yet called fintechs, to their member banks. That led me to being a VC at 500 startups, where I was the most active fintech investor in the world. We did 88 investments in 28 months in 26 countries. That's now a top decile fund, or at least it was until last week. And we just had our first unicorn, so that's not bad. And I did a whole bunch of work with banks and central banks on their innovation and investment strategies. And I did an industry-funded, not-for-profit, designed to educate folks about real-time data-rich payments. That was called 20022 Labs. And in 2019, I realized I don't really like being a VC. And so now I spend my time advising and providing governance to founders and emerging fund managers. So that's how I spend my time. And I moved from Silicon Valley to Lisbon about a year ago now, so I can spend time using my 35 years of experience to help Europe, Middle East, and Africa grow. All right, so for those of you who aren't deep in how VC works, this is the basic model. It reflects something that Jeff shared with us earlier today. VCs have an idea about where there's going to be outsized growth over the next 10 years. They convince LPs to give them money. They go invest in startups. Hopefully those startups generate returns so that the VCs can go raise more money. And it's worked reasonably well for the last 40 or 50 years. The business model, just to be clear for most VCs, is they get 20% of the profits after paying back their LPs, and they get these things called management fees, which are generally about 2% of the AUM that they have, at least during the investment period, if not for the whole life of the fund. And the rule for early stage VCs is that every single investment you do has to, if everything goes reasonably right, be able to return 3x or more of the size of the fund. All make sense so far? Okay. Here's the issue. The vast majority of VC investments fail to generate any returns. So the fact is that most VCs are not going to make money on the carry. Yet they tend to have a pretty high run rate in terms of their lifestyles. And so the real answer is that VCs never make an investment if it's not going to help them raise their next fund. They live management fee to management fee with the hopes of having a huge hit. We got lucky investing in fintech as early as we did. So when you are a fund manager, a general partner, and you're looking across the table at an entrepreneur, the things that you're actually wondering about as you're having that conversation are, can this company return 3x my fund if everything goes right? Is this company going to get markups in a reasonable time frame? Right? Are top tier VCs going to participate after me? Is this one of the best deals in this market segment? And if nothing else, the data I gather from the conversation with the entrepreneur, is it going to make me look smart at a cocktail party with LPs? Anyone want to argue with any of this yet? Okay. So what they're asking themselves is, can the share of the company that I buy return my whole fund, right? How much, despite protestations about how much support and help and everything else VCs are going to give an entrepreneur, the fact of the matter is they want to invest in people that don't need their time, so that they can spend more time talking to more companies, socializing with more LPs, and trying to raise their next fund. Despite the conversations about how important the team is at the early stage, the only thing a VC is actually looking at is, can the CEO raise the next round of funding without my help? So we have this great technical team and we've got all these people that came out of industry. No, if you can't, generally speaking, swagger in front of a VC and convince them to give you money, right, you're done. If you can't go out and win customers, you're done. If you can't recruit great people, you're done. CEOs have to be able to sell, and that's what VCs, generally speaking, are trying to evaluate. Then they're thinking about, how good is this company going to look in my quarterly report or my AGM? Right? And finally, will it, in the time frame that I have available, support my next fundraise? Does any of the entrepreneurs in the audience want to ask a question about this? Please. What do you mean?
Well, don't they know that most of these teams don't make money?
Of course they do.
And then they're not going to be returning the fund?
Of course they do.
So
but most LPs, at least institutional LPs, are hiring general partners to give them exposure to some certain growth in the market. And institutional LPs, in general, right, they don't want to do the direct investing themselves, so they want to evaluate the VC, make sure the VC is more or less following these protocols because they're proven to work. Right? Yeah.
Any VC ever given money to an experienced founder and not a 22-year-old they can push around and fire in an instant?
Has any VC ever given money to a someone older than 22?
Yeah. For my
I don't
experience
know.
with VCs,
Elizabeth
I'd
Holmes
never take
and Adam Newman did pretty well, right? At least in fintech, what I will say is the average age of the entrepreneur that we invested in, which delivered top decile performance, was like 38, maybe a bit older. And we certainly did a couple of investments in folks who were, well, closer to you and me. Right.
My serious question is, given all this reality, and how much I've seen the VC market change in 25 years, you'd have to be insane to be a founder to want to go to a VC as your source of capital if you had another option. Is that a fair statement?
That's probably a fair statement. Yeah, but our industry, meaning the startup ecosystem, has done such an amazing marketing job on be a unicorn, change the world, right? That most entrepreneurs, they think that that's the right route for them, right? It's, one of the reasons that I left Silicon Valley ultimately is when I got started, you got started, right? Entrepreneurs were people that did things that would make their mothers proud. And sometime around 2008, thank you, Travis, entrepreneurs were people that built companies to do for them what their mothers used to do for them. Drive them around and cook their food and all this kind of stuff, right? That's not, right? Okay. So here's my other, sort of maybe controversial statement. All early stage investing is momentum investing masquerading as fundamental investing. Who does not know what momentum investing means? It's all right. Okay, so you're all sophisticated. All right, so let me explain this statement by saying it is hard enough to build a startup without momentum behind you, right? Without some desire on the part of customers, on the part of partners, on the part of follow-on investors to think that the market is rising, which right now, for folks in and around what we do, the fact that the word crypto is the most toxic word in all of venture capital, like that's a momentum problem, right? Okay, so they do momentum investing because it makes their job a whole lot easier, right? And what it actually controls is not what company should I invest in. It controls what sector or subsector should I invest in? Why, right, should, as an LP, why should you invest with me? Because my focus is an area that's going through the roof, and I'm only, all the companies that are going through the roof are going to come to me, and I get to pick the best ones because I'm a magical money fairy and I know how to evaluate startups, right? But this is what momentum is all about, is what are you going to invest in? Now, all VCs, whether they have it explicitly or not, have some framework to analyze startups, at least at a first blush, right? When I was at 500 Startups, we saw 3,000 fintech startups from around the world every 6 months. And we did 88 investments in 2.5 years in 26 countries. And I can tell you for a fact that we used some of this when we would decide, should I invest in having another conversation? And the very first thing that gets asked is, tell me about your story, not your technology. I don't care about your product. I want to know what the giant, fast-moving problem is, so I can assess, is the market big enough? Ergo, if I write you a check, there's some chance that you're going to return my entire fund, right? And why is this moment in time the right time to invest in a company like yours, in a sector like yours, in a segment like yours? And to make the point, right, you need to be able as an entrepreneur, or if you're a GP trying to raise from an LP, you need to be able to support that assertion about what's a fast-moving market with real data. And it might be orthogonal data, but there's some kind of evidence that there's momentum, right? So when I went to raise my fintech fund with someone who was much smarter than I was, what we said is, right, this is 2016, we're investing in financial services for the rest of us. There are 3.5 billion people on the planet today who cannot be served by traditional financial services. Existing banks who spend 60% of their budget on compliance and remediation will never be able to drive down the cost so that they can serve those 3.5 billion people. Oh, and by the way, the emergence of Bitcoin has brought millions of entrepreneurs and entrepreneurs and engineers in to think about how they're going to disrupt financial services. Bitcoin, to me, as an equity investor, was only meaningful because it brought so many smart people into the market to think about, how do we disrupt this horrible industry? Right? So that's momentum. And I want to give an example, that is outside what we do, just to bring the point home. E-commerce fraud, right? So the data point that I'm going to talk about a specific company that I'll show you at the end of this little narrative, but they were working in e-commerce fraud. And what the founder noticed was that e-commerce penetration made 10 years of progress in the 8 weeks after COVID lockdown. That's a pretty compelling why now. So the data points that this entrepreneur had to work with was, due to COVID-19, e-commerce has accelerated more in the last 6 months than in the prior 10 years. 76% of all online retailers want to use AI to reduce fraud, because AI fraud prevention will save retailers 30% of the $100 billion a year that they lose to fraud, and only 1% of that savings, and you have to be careful about this, but the point is, 1% of the savings this year is a $300 million market. That's a pretty good why now, yeah? So the way that the pitch was put together is this, where the easiest way for e-commerce merchants to maintain margins. Nothing about technology. As software eats retail, retailers cannot compete with Amazon spending. And having great fraud prevention means more margin for merchants. Nothing about technology. Our world-class fraud management takes only minutes for any merchant to install and gets better with every single merchant, right, that comes onto our platform. That's a pretty compelling narrative. Took him 6 weeks to raise a $205 million Series E. Okay? So entrepreneurs, as you think about going to raise your next round, don't talk about your technology. No one cares. They only care insofar as that's what they promise to invest in to their LPs. What they care about is that your equity is going to become worth something quickly. All right. So now let's talk about where Unbounded's focused and why I'm excited. Here's the market momentum we're playing into. Right? Fintech projected to grow, even though it's been, hammered. VC investment in fintech is down 85% in the last 2 quarters. Ridiculous. But it's still projected to go, right, at nearly 30% growth. And that's because of really 2 main things that play into Unbounded's thesis. One is financial services for emerging markets, where you can only deliver them if you can crush the cost of moving a payment around. And the second one is, as Garrett talked to us about, there's today on that side, right? There's about $12 trillion in market cap in financial services companies, and fintech is only about 2% of that. So there's lots of room to grow there. But financial assets is $98 trillion worth of market cap. Most of it is done on paper. And so to digitalize management of financial assets, that's kind of a big win. Gaming, we heard from Handcash earlier today, like gaming got big as everyone was locked at home, right? Coming out of COVID, online gaming was bigger than sports, music, and movies combined. And it just keeps going because, well, people like gaming apparently. And then finally, real-time payments, which is, as we heard from BSV, right, is part and parcel of that value proposition. And that's going that way because governments and banks know that if they don't modernize their payment infrastructure, they won't be able to keep up with GDP in a digital economy. And now that they have, net interest margin to spend on innovation programs, they can go ahead and do it. This is why I'm excited about Unbounded.